All right, so you're here because you want to understand, like the really big stories in finance.
Well, they got to shake things up.
Exactly. And the GameStop saga, oh man, that was definitely a shakeup, a real roller coaster.
No kidding. It captured everyone's attention.
For sure. And today we're going deep, a deep dive into GameStop, but through a very particular lens.
Hmm. Intriguing.
Yeah, we got our hands on this internal document from a hedge fund, GameStop it's called.
The hedge fund's perspective. That's fascinating.
Right. And our mission today is to, well, kind of unpack their experience. How did they actually navigate this whole crazy GameStop situation? What were their moves?
And what did they learn from it?
Precisely.
Yeah.
So let's start with the basics. What's the deal with hedge funds anyway? Why is it that, most people, including myself, have never even considered investing in one?
Yeah, that's a great question. So at the core, hedge funds are, they're all about making money for their investors. And they use all sorts of sophisticated strategies to do that. But historically, there's been a really, really high bar to get in.
Like, how high are we talking?
Well, this document puts it pretty bluntly. It says, simply put, the rich get richer because they can get into a hedge fund, and the poor get poorer because they can't.
Wow, straight to the point.
Right. And we're talking, millions of dollars. Typically, you even get your foot in the door. And even then, they advise it should only be a small portion of your total wealth.
Okay, so it's like this exclusive club that most people are just automatically excluded from.
Exactly. And that's why most of us, we're kind of left wondering what really goes on in these hedge funds.
Okay, so let's bring GameStop into the picture now. This particular hedge fund, they saw GameStop, it used to be this thriving business renting out CD games, but then digital downloads came along.
Yeah, the whole landscape changed.
And they were clearly struggling. So what was the hedge fund's initial play?
Well, they did their analysis and decided to go with a short-selling strategy. Basically, they were betting that GameStop's stock price would continue to go down.
Short selling. Remind me how that works again.
Sure, it involves borrowing shares of a stock, selling them at the current market price, and then hoping to buy them back later at a lower price to return to the lender.
Ah, got it. So they profit from the difference.
Precisely. And they saw this as as they put it, a calculated move based on, where they thought GameStop was headed.
But then this is where things get really interesting. This whole army of retail investors online, they had other plans.
Yeah, talk about a twist no one saw coming.
Right. So let's break this down. What happened?
Well, they underestimated the power of, regular people connecting and coordinating on social media. This group of retail investors, they rallied around GameStop.
Yeah.
And it wasn't necessarily based on traditional financial analysis. It was almost like a statement.
Like a rebellion against the establishment or something?
Yeah, you could say that. Their strategy was simple. Buy and hold. Keep buying the stock, drive the price up, and don't sell.
And that's what really triggered the short squeeze, right?
Exactly. As more and more people bought the stock, the price started to climb. And the hedge fund, they started feeling the pressure.
Because they had bet on the price going down, not up.
Right. They had to start buying back those shares they had shorted to limit their losses, but that just fueled the fire.
So this buying frenzy just kept pushing the price higher and higher?
Exactly. And the document, it actually says they were caught us off guard, they faced mounting losses, and had to scramble to buy back the shares we had sold at much higher prices.
Ouch. So at that point, it seemed like the retail investors had won, right?
It sure looked that way.
But hold on, there's another twist coming, right?
There is. You see, the hedge fund, even though they were caught off guard, they were watching closely.
Smart.
And they noticed that after the initial, crazy spike, GameStop stock price, it started to come back down.
Ah, so what did they do?
Well, they saw an opportunity. They decided to short the shares again, but this time at those inflated prices.
So they were betting that the price would continue to fall back down.
Exactly.
Yeah.
Because they realized that initial surge wasn't really based on, the actual value of the company.
It was more like hype and speculation.
Right. So they anticipated a correction, a return to a more, realistic price.
So did it work? Did their second short-selling move pay off?
It did. The stock price did indeed fall, and they were able to buy back those shares at a much lower price than they had shorted them for.
So they ended up making a profit.
Substantial profits, the document says. They managed to recoup their initial losses and then some.
Wow, that's quite a turnaround.
It is. And it really highlights, the importance of being adaptable in the markets. Things can change quickly, and you have to be able to adjust your strategy.
Absolutely. So, besides adaptability, what other key takeaways did these hedge fund managers highlight in this document?
Well, there are a few that really stand out. One manager stressed the importance of, being able to adapt and turn that surprise into a defining success story.
Yeah, turning lemons into lemonade, so to speak.
Exactly. Another manager talked about the need to recognize and capitalize on unexpected opportunities.
Which is, I guess, easier said than done.
For sure. But it's crucial in a volatile market like this. There was also a really interesting observation about how the lines are blurring between, what we used to think of as retail investors and institutional investors.
Like the everyday people versus the big players.
Right. And they acknowledged the strategic imperative of understanding and engaging with these online communities.
Because they can move markets now.
Absolutely. And finally, they emphasize the ability to achieve success through what they call strategic maneuvering, even when you're faced with completely unforeseen events.
So, being able to think on your feet and adapt to changing circumstances.
Ex-
Now, there's this other thing mentioned in the document, hedge compass. Can you tell us a little about that? What is it, and how does it fit into this whole story?
Yeah, so hedge compass, in a nutshell, it's presented as a concept, a way to, potentially democratize hedge funds.
Democratize hedge funds, so like make them accessible to regular people.
Exactly. The idea is that anyone could buy these tokens, a link to a stablecoin called Tether, and these tokens would go up or down in value based on how well the hedge fund was doing.
Interesting. So it's like a way to, maybe get a piece of those returns that have historically been reserved for the super wealthy.
Right. The document even asks, imagine how you might benefit from holding Hedge Compass, which were linked to these hedge funds.
Food for thought for sure. So to kind of wrap things up, what we've seen here is, well, the unexpected power of collective action, right?
Definitely.
And how crucial it is to be adaptable in the financial markets because things can change so fast.
No kidding.
And then there's this whole idea of, potentially making these sophisticated investment strategies available to more people.
It's definitely a fascinating development. The GameStop saga, it really shows how the landscape is changing, and it's a reminder for everyone, to stay informed, stay nimble.
Be ready for anything.
Precisely.
So, as we leave you today, a final thought to ponder. With information spreading so quickly and all these new ways to access financial markets emerging, are we going to see more of these unexpected events, these market disruptions? And if so, what's your best strategy as an individual investor to navigate this new world? Thanks for joining us on this deep dive.
Thanks for having me.